Thank you very much. And it's a real pleasure to be back here again. I must say it's an impressive group that's been put together, and it's a pleasure to have that headed up by Representatives Benchmark and one of our great companies that we work with, Novonix. What we're doing, first of all, if I could just talk about where a lake is positioned. We're in the lithium triangle. This is where very large projects are based, generally at the low end of the cost curve. And all of the 5 major players are here. We're fortunate in having a very large property position, 2,200 square kilometers. I'm going to be talking about our flagship project, Kachi, which is just down the road from the longest term producer here, Hombre Muerto, which is Livent's operation in country. Next slide, please. What we do at Lake is fundamentally different to others in the lithium space. We're focused on producing a cleaner lithium and doing that with ESG benefits. So if I go back in time a little, we put this company together back 2015, 2016 with these assets. And by the time we were drilling our major project, Kachi, we could see it was large, but the end users were telling us that they needed a consistent, clean, high quality product. And we heard references to that both from Benchmark and some of our earlier presenters. But the only way to do that was to use a new technology. Using the current technologies just wasn't going to cut it. And that's why we went down the path of hunting around, finding a direct extraction method. And we settled with Lilac, who use a very well-known form of water treatment called ion exchange. The benefit of ion exchange, not only was it well known and it's been widely used for 70+ years, they had just adapted it for lithium. And so we could replace these big evaporation ponds with their direct extraction process. And in the process, just take the lithium out of the water rather than concentrate all the salts. And through that, we could develop a much cleaner way of processing it, much less water usage, much lower land usage, but best of all, produce a very consistent high purity product. Now we've gone through the path of pilot plant testing. We've gone prior to that benchtop testing. We aim to have a demonstration plant on site towards the end of this year. We're currently in debt finance discussions. We're currently in discussions with off-takers, a detailed feasibility study underway and targeting financial close for middle of next year and production first half of 2024. But the key differences I want to emphasize here is high purity, scalable with ESG benefits. Next slide, please. So what does that look like? As I was saying before, up here on the top right-hand corner, this is a traditional method. You pump out this, or imagine something like Death Valley in California, this arid dry salt lake. You pump the salty water from underneath it. That's where the lithium is dissolved. And at the moment, you put it in an evaporation pond, you concentrate all the salts, the water gets evaporated away, and you separate out the lithium. Nothing wrong with that process, but it's been around for many centuries. What we're doing is using something that was developed in the 20th century and adapt it for the 21st century. Pump out that water, just separate out the lithium using ion exchange beads. That means we can return that water back to its source. By that very fact, we produce a very high purity product, and then that gets cleaned up into lithium carbonate. Next slide, please. And over these next 3 slides, I'm going to show you what that means from an ESG perspective. First of all, instead of evaporation ponds heading out across the horizon, covering 10, 20, 30 square kilometers, we're talking about something which is the size of 1 or 2 city blocks. So much smaller land usage. Next slide. And at the same time, instead of all of that water, albeit non-potable, it's salty, but instead of all that water being evaporated away, we return virtually all of it back to where it comes from. So orders of magnitude difference in the use of water, orders of magnitude difference in the size. Next slide, please. One of the benefits that all the brine producers do have is generally a small carbon footprint because they use power of the sun, but most of the plants are powered by natural gas to convert into carbonate. We're looking to use most of that as a solar PV farm. And so all of these brine evaporators have a small carbon footprint. Ours is probably going to be smaller, but in comparison to hard rock, again, a number of orders of magnitude smaller. Because we don't just look at digging a hole in the ground, we have to look at the fact that that's then processed into hydroxide, which is highly energy intensive. Next slide, please. The other great thing about using direct lithium extraction is it's modular, and so you can scale it up easily. We have a pre-feasibility study out that shows that we can operate at 25,000 tonnes per annum. We're now expanding that to 50,000 tonnes per annum, and that's been driven by demand and also the support of debt. Next slide, please. Of course, we have to demonstrate our product is high quality, and thanks to Novonix, they demonstrated that this product works very well in initial testing in NMC 622 batteries. We aim to be doing more work with them in the future, and I want to have a shout out to Novonix, an outstanding company if you get a chance to have a look at them. Next slide, please. And one of the beauties of producing a high quality product is you get a consistent high margin. And I'm talking a serious high margin. Some of the lithium brine producers at the moment might be making $1,500, maybe $4,000 a tonne margin. At the moment, we could be making anywhere from $8,000 to $10,000 a tonne margin. That's because a consistent high quality product that doesn't need to be reprocessed. There's nothing wrong with the other products. They just normally need to be reprocessed into its final product. Next slide, please. So what does our project look like? It looks like any of these other brine basins. They're large, it's dry, it maybe rains once a year, once every 5 years. Our key difference is we basically own the entire basin with mining leases. Our current resource is large, but only 20% of that is for 25 years of production. If we double production, we can do that easily enough. And that's why we've got the rigs back here to support that. It really is, we've got the opportunity to develop this to really the size that the market wants. Next slide, please. And through the pre-feasibility study that we recently refreshed, the numbers are really quite compelling. A post-tax NPV8 of 1.6 billion US, EBITDA line of 260 million a year. With the debt servicing and the conversations we're having with debt providers, we might only need 50 million of that each year to service the debt over 10 years. It really becomes quite a compelling project. And if we scale it up to 51,000 tonnes per annum, our operating costs come down and that post-tax NPV will look even better. Next slide, please. So if we look at our timeline, we're doing the bread and butter issues at the moment: definitive feasibility study, environmental social impact assessment. That's due first quarter next year. Maybe the ESIA a little bit later than that. We need to do that so that we can secure the finance. Before we finish the DFS, you can expect the demonstration plant on site. It would be there now if not for COVID. We've been operating a pilot plant for some time in California. We're more samples off to battery makers and potential offtake partners. We're currently in discussions with project financiers. They're predominantly export credit agencies. We're talking 10-year debt, 70% of it being funded, and interest rates around 3%. And then when we go through financial close, the middle of next year, moving into construction and then production for first half 2024, and quite possibly the expansion case soon after. Next slide, please. Where are we at the moment? We're valued about 400 million Aussie, about 300 million US. We've got cash in the bank to take us to financial close and then some. Share price about 40 cents. And it's been fairly solidly supported since February. Next slide, please. But there's still significant upside. If we look at our peers, we're trading 15–20% of NPV. Our peers are trading 30 to 80%. Our closest peer is an excellent company called Standard Lithium, ticker code SLI on the New York Stock Exchange. $1 billion market value. They only own 30% of their project. We've got price targets, many orders of magnitude where we are at the moment. There's a lot to come down yet. So watch this space. Next slide, please. And so to finalize what we're doing, we need a lot of lithium, whether that's 10 times, whether that's 15 times over the next 10 years. But what we're doing is producing a consistent high quality product that we know the end market wants. We're producing it with new technology so that it's consistently high quality. And with that, we get major ESG benefits. And I have to say, this is what's driving the conversations that we're currently having with EV makers and battery makers. They want to see this in their supply chain. And that echoes some of the comments you heard from Euro Manganese and also from Benchmark. So on that, thank you very much. I hand it over to questions.
Thanks, Steve. Now, you recently announced the issue of bonus options, which I don't think too many shareholders quite understand what bonus options are. Can you explain how that works for a shareholder of Lake?
Certainly. If I can provide some context, we did a capital raising in January this year over the Australia Day long weekend, and shareholders breathed a sigh of relief because we were finally financed through to our key investment decision in the middle of next year. But some of them were not entirely happy that they didn't get a chance to participate in that. So what we wanted to do is to thank our shareholders and issue them a bonus option. At the moment, we're only able to do that under Australian securities law, but we are looking at ways where participants from offshore can share in that as well. Believe me, we'd like to do that. How it works is on the record date, which at the moment is indicatively the 10th of August. If you own shares in Lake, let's say you own 100,000 shares, then you get 10,000 bonus options. It's a 1 for 10 offer. You don't have to do anything. They'll just turn up on your register. And when we get around to the weeks leading up to the 15th October, each shareholder would then need to make a decision. Do I exercise some of those options, all of those options, or none? And if you do, you pay 35 cents to buy and convert that option into a share, and you pay that money to Lake. You get a share at 35 cents, and then you also get an additional option with a 75 cent exercise price and expiry in June next year. And we aim to have those listed so that they would then be tradable about 6 weeks later. The idea of that is that shareholders who are currently on our register get to participate. Looking forward, if and when we do a capital raising somewhere between now and next time next year, that'll predominantly be with institutional funds. This is a way where they can share in that. We're looking to do a raise of about 100 million US by the middle of next year. We can see that a chunk of that change will probably come from these bonus options and their conversion. And so it's a way to both thank shareholders and also to have them engage with us going forward. And you can see from where we expect the share price to go, we also reasonably expect those options at 75 cents to be in the money by the middle of next year.
Thanks, Steve. Now, the ongoing exploration is designed to obviously increase the resources and to underwrite a doubling of production. However, this data is kind of not in the DFS. Is this likely to change given the strong demand for lithium globally?
So the short answer to that is yes. If you'd asked me that even 2 months ago, I probably would have said no. But we're drilling at the moment both to provide the DFS with the robustness that's required for project financing. That's to convert some of the resources into reserves, but it's also to upgrade resources into measured and indicated. We're quite confident that's going to happen. Honestly, it's just a matter of number of wells and hole density, and then we'll be doing pump tests on that. The key things that we were looking for was that the off-takers wanted to see that extra demand, and pretty much the conversations we've had, they want to buy everything we're going to be producing for the first 5 or 6 years. So we probably need to be producing more. And then the debt providers are quite keen, if possible. Indicatively, they've shown support to that expanded case. So the DFS will probably come out with a second option showing that expansion case.